I shall resign the presidency effective at noon tomorrow.
Hello everyone, and welcome to another episode of Mundo de História, and the second episode full in English. Today I have the privilege and honor of receiving here in an online way Robert Bruner. Welcome, Professor.
Thank you. It's a pleasure to be here.
Before we talk about the theme of this episode, I want Professor to introduce himself a little bit, some about his experience, his college life, and what are you working on these days?
Thank you. I am a professor at the University of Virginia. I specialize in finance. I am working principally on financial crises these days, writing about them, studying them, teaching about them, and they've been a subject of enduring interest. My training has been in the field of financial economics. I have an undergraduate degree from Yale University and graduate degrees, a Master of Business Administration and a doctorate in business administration from Harvard University. My area of special training was financial economics. And for many years, I focused on corporate finance, teaching about mergers and acquisitions, how companies finance themselves, how they invest money, and so on. But in recent years, I've turned to financial crises. I live in Charlottesville, Virginia, which is on the east coast of the United States. My town is in the mountains, a few hundred miles inland from the ocean, but it is nonetheless regarded by many Americans to be on the eastern side of the country. The University of Virginia is a state-funded institution. It routinely ranks among the very highest of colleges and universities in the United States. And we have within the university the Darden Graduate School of Business, of which I am a faculty member. I've been a faculty member here for 41 years. I served as dean of the school for 10 years. And I have a wife and two sons. We like where we live. I like what I do.
Thank you, Professor. So you have dedicated almost all your life to study and teaching.
Yes.
I'm studying to become a teacher. I hope so to become a teacher in the Federal University of Minas Gerais, where I study. You're the first person on my podcast that it isn't a historian, so it's an honor to have an economist here too. And as a teacher said, he is a specialist in financial crisis, and he has agreed to talk a little bit about the US crisis of 2008, the subprime crisis. And before that, how was the US economy before the big crash in 2008?
The US economy for about 5 years before the crash of 2008 was very strong. And indeed, this is a regularity among financial crises in history. They tend to follow a period of boom, of rising economic activity. The US had experienced a recession, a very short and shallow recession, beginning in 2001 and ending in early 2002. And this recession followed a collapse in the stock market called the dot-com crash in 2000, 2001. And prior to that, there had been a 10-year expansion in the economy in the United States. So think of it as a very long boom, a very short, shallow recession, and then another boom. The boom in the early 2000s was particularly a boom in consumption and in housing. And housing proves to be a central part of the story of the crisis of 2008. But for a number of reasons, housing took off as an investment focus for many individuals and families because interest rates were low. Interest rates were low for various reasons, in part because of the policies of the central bank in the United States, and in part because countries around the world, especially China, were investing their excess reserves in U.S. Treasury securities, and rising demand means that prices for those securities rise, which means that interest rates fall. Well, a declining interest rate environment is another regularity of the booms that precede big crises. And for these and other possible reasons, the economy felt quite strong.
If I'm not mistaken, the rate in the United States now is around 4 or 5%, right?
Yes.
And before 2008, what was the interest rate?
I can't give you the precise number, but it was uh, uh, probably in the mid single digit range. And, we quote interest rates in terms of a benchmark, and the benchmark most commonly used is the yield on the 10-year Treasury security in the United States. Today, that's about 3.5 to 4%. And then all other debt instruments in the U.S. and many of them around the world are quoted as a premium over the yield on the 10-year U.S. Treasury. Mortgage rates in the United States, for instance, right now are in the high 6%, low 7% range. That is a typical spread or premium over the 10-year Treasuries. But back in the mid 2000s, that was regarded to be an attractive mortgage rate, and it was stimulated by the belief on the part of many people that housing specifically and real estate in general would be very, very attractive long-term investment targets. So people began to flow their savings into housing and other forms of real estate, such as office buildings, and retail centers and factory buildings, etc., but predominantly into houses. And this created quite a boom. And as happens during bubbles, early increases in prices tend to bring in more investors, and those more investors tend to bid up the prices on the assets, and so a self-reinforcing spiral begins. And that was the experience of much of the mid 2000s until about late 2006 or early 2007. And we can talk about what happened next when you're ready.
Yes. I said in the beginning that we'll talk about the subprime crisis, but what is a subprime?
Subprime debt is debt that is risky. So prime debt is debt that is relatively less risky. It's not perfectly riskless, but prime debt has very creditworthy debt ratings by independent rating agencies, and subprime debt has risky debt ratings by independent agencies. You should know that subprime debt that mattered in the mid 2000s was subprime mortgage debt, and mortgages in the United States for probably 2 decades had been the subject of a of an innovation in markets, which was to package many mortgages into portfolios of mortgages and then to sell off parts of the portfolios that were less risky and other parts that were more risky. So um, you as an investor in the mid 2000s would not buy an individual mortgage. You would buy a claim on a portfolio of mortgages that were either prime or subprime. And if you bought subprime mortgages, you earned a fairly high rate of return, judged by the benchmarks of that day, and you took some more risk. But the belief was that the risk in housing was rather low because over many years, house prices had only risen, or if they had not risen, they had nonetheless retained their value. And so it seemed that housing prices had only one way to go, and that's up. And of course, that's a standard belief during a bubble, which is that there's no downside, there's only an upside, and therefore you can invest with security, with confidence in the belief that even though it says subprime, even though it says more risky, really these aren't very risky at all. On top of which you earn a very attractive rate of return. And this was the appeal. This was the magnetic draw of uh, housing at the time.
So basically, I would buy a house and get a mortgage for the house, and the bank would sell my mortgage to another person, and this person would win all the interest or the value of the mortgage.
That's right. The bank would bundle many mortgages into a portfolio and then sell claims on the portfolio. If this sounds complicated, it is. And indeed, that complication is one of the uh, uh, stimulative factors in the crisis, meaning it made it very, the complexity made it very difficult to understand what the true risk was in any portfolio specifically, but in all the mortgage portfolios in general, because very large institutions such as pension funds or institutional investors, for instance, would invest heavily in mortgages, in mortgage related securities, and they would have belief that these securities were less risky, even though they yielded a high return. And indeed, many of the mortgages had the backing of the federal government, the belief that the federal government stood behind these mortgages, guaranteed the mortgages. In other words, even though they said subprime on them, they didn't take into account the risk they were taking. And so all of this complexity created what, in my belief, is one of the dominant features of the crisis of 2008, namely an inability to really understand what were the risks, what was the probable return, how resilient were these assets in the face of a downturn, and the like. Um, and then the fact that many of these securities were owned by important financial institutions meant that if the securities defaulted on their payments to investors, it meant that those financial institutions would also possibly default, but certainly the financial institutions might decline in value. Their assets might decline, and that would worry depositors to those banks and investors in those institutions.
It's possible to know how much money was landed, how much money it was in mortgage, in all those loans in the United States before the crisis.
A very large amount. there are competing estimates, and I can't endorse any one of them in particular, but um, uh, the housing finance, real estate finance field is so large that it may well be in the neighborhood of $1 trillion or $2 trillion that generated the crisis. Now, you should know that mortgage finance has been going on for 100 years or more. It began very seriously in the 1930s, but has been preceded by bank lending to finance real estate well before that. In any event, for us to talk about the amount of total investment outstanding today in real estate, we'd be talking about many trillions of dollars. And the real estate field is a major focus for investing. It isn't the only one. It competes obviously with stocks and bonds and other kinds of securities, but real estate is quite significant, and it's significant in part because it is a cyclical field. So when interest rates rise, people who are less interested in buying new houses, they're less interested in buying old houses, they're less interested in buying. They just sit still, and so the housing industry expands and contracts as the business cycle booms and busts, and therefore there is it's difficult to pinpoint in time as being representative of the experience of an entire decade. Suffice it to say, the field is massively important to finance in general and to the American and to the world economy, and it is therefore an indicator of what the future of the economy might be. So when housing begins to contract, when it begins to shrink, when new home starts, construction of new homes begins to decline, that's an early indicator of what might be a recession.
So I have almost 10 years of a booming market of houses, of a booming of a expansion of loans, of mortgages, and we know by fact that every bubble pops one time. When was the time? Can you say like there was a specific day when the bubble actually popped and the crisis began, or it was a few days, a few weeks?
Um, the housing market peaked in the first quarter of 2006, and you can look at indexes such as the Case-Shiller house price index, and it shows that it peaks and it remains flat there for a few months and then begins to decline. By late 2006, the real estate field was definitely in decline. But the large question is, why did it? What prompted house prices to stop rising? And the short answer is the unwillingness of lenders and creditors of all kinds to continue to finance new house purchases. And I have looked very carefully at the data and conclude that the change in attitude by lenders began in September of 2005, and it follows the impact of Hurricane Katrina, which landed in the United States, hit New Orleans in late August. August 28th, I believe, is the date, 2005. It devastated the Gulf Coast region. It triggered massive insurance claims. And I believe that the change in credit sentiment began following the damage of Hurricane Katrina. And This is consistent with some other research that I've done and that others have done that links the beginning of a financial crisis to some external effect that causes a sharp change in investor sentiment. I've written a book on the Panic of 1907, and researchers have identified the earthquake in San Francisco in April of 2006, about 18 months before the actual panic. The earthquake as being the stimulus of a credit contraction that ultimately resulted in the Panic of 1907. Similarly, I believe that the credit contraction that led to the downturn in housing prices, that led to the subprime debt crisis, that led to the panic of 2008, began with Hurricane Katrina in 2005.
I actually had never heard about this connection, but it makes a lot of sense. So it was a mix of a lot of loans be given and the nature acting that led to the crisis. But was the crisis avoidable, or the government had nothing to do, just to wait and hope it would pass?
Uh, Whether a crisis is avoidable is a very deep and profound question. With perfect foresight, it would have been possible for the central bank of the United States to flood the economy with cash and to sustain the economy, to provide the liquidity that would have prevented the various institutions from entering financial crisis. But that kind of action would have required a degree of extraordinary foresight that most regulators do not have. Usually, in my studies of financial crises lead me to conclude that the decision makers inevitably wait until the signs of a crisis are very strong before they begin to take action. And this is for several reasons. One is there's a great deal of imperfect information. The data are very noisy, as we say. They're very imperfect, and it's hard to tell whether a crisis for sure is here, but also it's hard to tell how severe the crisis will be. It's hard to tell where the crisis is starting, and so on. You were absolutely correct in pointing to the fact that the crisis begins in one place and then it moves elsewhere and elsewhere, and this is what you and I would call the domino effect. We set up the dominoes, and then the first one falls over, and many others fall over as well. You have to stop a crisis very, very early in the dominoes in order to prevent much damage. Waiting as late as they did in 2008 inevitably meant there would be a great deal of damage.
And as you said, it was a domino effect. And how was the effect in the US? We know that a lot of banks went bankrupt, and I wonder why those banks that had a lot of money broke, and how the whole society of the United States and the world actually were affected by this crisis.
Um, this crisis, as all crises do, began in the shadows, in the periphery of the financial system rather than in the center. Why is that? It's because the institutions at the center tend to be larger, better capitalized. They hold more diverse portfolios, and therefore they're more insured against risks. They're stronger in all ways. It's the financial institutions, the banks in the shadows, as it is said, or in the periphery, as I prefer to call it, that tend to be less well regulated. They tend to be more aggressive in their management. They tend to have less well diversified portfolios, and therefore they're less able to withstand shocks. And we just talked about the role of shocks, Hurricane Katrina or the San Francisco earthquake, big, surprising, costly, unanticipated events that overwhelm financial institutions. Well, they begin in the shadows, in the periphery, and gradually move through a process of connectivity through to the center of a financial system, and that's the domino series. Now, since globalization of finance that began in the 1960s, 1970s, but in the private sectors, it truly became quite serious in the 1980s, 90s, and 2000s. With the globalization of finance, the crises no longer are simply domestic problems. They tend to spill across borders. And when the crises begin within one of the major developed economies, it is inevitable that other countries will feel the crisis. The crisis of 2008, as some have pointed out, was mainly a North Atlantic crisis. Asia was relatively unaffected. Latin America was, all countries in the world were affected in one way or another, but they did not experience the crisis of 2008 the way the United States, Britain, France, Germany experienced the crisis. Ireland, Iceland were countries that experienced severe impact of the crisis. And the reason for that is the linkage among financial institutions across borders, the investment of hedge funds in France, in subprime debt in the United States, the reliance of currencies on pegs to the dollar, for instance, the reliance on pension funds in various countries to be invested in the stocks of companies in other countries. All of these are examples of the cross-border linkages of the global economy right now and of finance. But generally, these linkages are very, very good things. They lead to better diversification for your and my pensions. They lead to probably higher rates of return than we would otherwise get. They lead to more benefits, but there are these episodes, such as crises, when we confront the fact that the global economy has grown interdependent across borders in very serious ways. So I would say that the whole world was affected, but the greatest damage, the greatest impact was in the North Atlantic region. In a similar crisis occurred in the late 1990s, 1996 to 1998. There were a series of crises in Thailand, Hong Kong, South Korea, Indonesia, and then Russia. And only toward the late stage did those crises spill over into the United States with the collapse of long-term capital management in 1998. But generally speaking, the Asian flu crisis, as it was called, was contained to West Asia, East Asia, the eastern seaboard of Asia. But the other crises, there was a currency crisis in Mexico in 1993-94 that was relatively well contained. Argentina has been through a series of crises over time. Those have managed to remain relatively well contained. But what distinguished the crisis of 2008 was it, more than most other crises, had a truly global impact.
Two questions. The the whole commerce, the international commerce, is paid by dollars. The fact that the world depends in dollars helped the countries, the northern countries, to suffer with this crisis, and how the commodities market was affected by this crisis.
Commodity markets were affected because of the general slump in economic activity that the crisis caused. So we just bought less lumber, less cocoa, less copper. We consumed less because we all were feeling poorer than we were before. Um, the the linkage across borders to the U.S. dollar is an undeniable means by which the contagion of a crisis spreads to more countries. Contagion is a very important word here, and it's important particularly in currency-related crises. Um, the many crises in emerging economies are related to either instability in the exchange rates between their domestic currencies and the reserve currencies, the U.S. dollar, the pound sterling, the euro, the Japanese yen. Some believe that the Chinese yuan is going to become a reserve currency. It is not now and is unlikely to be for many years yet. But when when emerging economies, when the nations and or their companies borrow to finance their growth, which is a good thing, they often face a two-tier market. They can borrow in local currency at a very expensive rate, or they can borrow in dollars at a less expensive rate. And so many debtors in emerging economies will tend to borrow in dollars, but that carries with it the risk that the exchange rate will move against the local currency, thus requiring the debtor to pay more in local currency to service that dollar-based debt. This would be true if the emerging economies borrowed in euros or yen or pounds, but the dollar is the most frequently cited um, reserve currency. Now, the dollar itself is affected by activities within the US economy and within the central bank of the United States. So when the central bank raises interest rates, investors around the world tend to move their spare money into dollars and into investments in the United States because they want to earn the higher returns. Well, that causes interest rates to change, to move adversely against the local currencies, and that imposes more pain on the economies of the emerging countries. Um, all of this says that we are in a highly networked, highly interdependent international financial system in which the the largest countries and the countries with the most developed financial systems tend to have more influence on the course of uh, crises or the course of prosperity than do other countries. And this is, I know, a source of great controversy around the world. It has always been the case. It was true back when Britain was the global financial leader, and before then, when France was a global, and Italy, and so on. But it is the case today.
Have talked about the big people. I want to talk about the regular people, the workers in the United States. How were they affected? Because it's common to see movies, documentaries about 2008, and we see families losing their houses, their all their money? How was the effect in the regular people?
So the regular people were definitely affected. I would begin by pointing to uh, the unemployment rate in the United States rose to 10% higher, in fact, than that in some ways. And the average unemployment rate, of course, ignores the differences within the population. Younger people were unemployed at a faster rate than older people. Uh, Women were unemployed disproportionately. People in racial minorities, African Americans and Hispanic Americans, were unemployed at disproportionately higher rates. Basically, people in wage earning jobs in lower rates of compensation were unemployed at higher rates than were people in salaried jobs, and therefore, to say that the population had an unemployment rate of 10 or 11 or 12% ignores the fact that youth unemployment for African Americans rose dramatically higher than that for a period of several years. And this, of course, led to an increased concern with economic inequality within the United States. I know that's been a topic in countries around the world, but every time there's a crisis, concerns about economic inequality just take off, and justifiably, because crises expose the weak points in an economy and the points of greatest vulnerability in a society. Um, we saw, beside unemployment and economic inequality, we saw that some regions of the country experienced a larger downturn. Some old manufacturing regions experienced a sharper downturn than younger growth areas. Washington, D.C., which is our national capital, actually grew in population and income during the crisis. This was the source of some animosity in the rest of the nation. How can the government prosper when the rest of the country feels so poor? Some industries which are more cycle sensitive, such as home construction, mining, and some air travel, experienced very sharp downturns, and bankruptcies increased within the U.S. economy. And the bankruptcies, of course, were disproportionately focused on smaller and mid-sized companies, which tend to be the growth engines of any economy. That's not a good thing when those companies take a disproportionate hit. And large companies, large, well-diversified, well-capitalized companies made it through the crisis, some with great difficulty and some with less difficulty. The automobile companies needed government loans. Airlines needed help, some others, but healthcare, pharmaceutical companies made it through the crisis in fairly good shape, for example. Everybody needs medicine at some point, and so the demand for those products did not change much. I would just say that uh, uh, crises uh, reveal the asymmetries, the differences within a society much more sharply than do periods of prosperity.
I agree totally. And I imagine that the banks, the investors that aren't getting money start to get less money because the people hadn't money to buy to not to buy but to pay the mortgage, the loans. So imagine the whole crisis get even worse in that moment.
Yeah, and banks, of course, as we know, subsequently banks began to reduce their lending, partly because they became risk intolerant, risk avoiders. They tightened up on lending. They called in loans. They refused to make new loans because no one knew how much worse the crisis of 2008 was going to get. My gosh, you had very large financial institutions being bought by others, being supported by the federal government because they were in difficulty. No one had seen anything like this for 75 years, and therefore the banks became much more risk avoidant. Um, other lenders, of course, in the periphery, mortgage loan companies, pension companies, family members, began to cut back on the loans they would give to others. And of course, this then commences a very bad spiral that is called a debt deflation spiral. It's been discussed by many prominent economists, and it causes debtors to have to sell assets in order to repay loans and or simply to meet interest payments. And when they sell those assets, prices decline for those assets. And as prices decline, lenders ask for even more collateral, more of a commitment of assets to back up the loans that they've made. And with every new round of demand for collateral, more assets get sold, asset prices fall, more collateral is demanded, and in theory, this downward spiral could continue until the whole economy is totally ruined. But fortunately, governments step in and provide liquidity. They lend where other lenders won't. They provide the ability for small and medium-sized businesses to get loans to meet payrolls and to continue their business. So this commences a crisis. Typically commences a process of scarring. It's like creating a wound on a human body, and the wound closes, but a scar remains. And people who have lived through a crisis remember what the crisis was like. It's like victims of crime or veterans of military combat. You live with the consequences of that memory for the rest of your life. And as a result, people who lived through the Great Depression remember being on the edge of starvation, and they carried that with them through the rest of their lives, being very, very careful about how they would spend money and use money, and they would hoard their savings very, very carefully. And the fear was that in the crisis of 2008, we would see that again, and that this would scar the generations alive at that time for many decades to come. It appears that some of that has happened. It appears, we'll really only be able to know 1 or 2 decades from now how true that is. But the economics of crises are pretty clear already, that they tend to produce lower economic growth after the crisis than existed beforehand, and that's bad. We all benefit from higher economic growth.
As you said, the economy was in a spiral of going down and down and down, and the government had to step in. So basically, the government gave a lot of money to the banks, not gave, but loan, not amount to banks, big industries. If I'm not mistaken, General Motors got a big load of the government. And the Fed, did the Fed rose the interest taxes?
Um, that's one of the interesting details. The answer is no. The Fed actually lowered interest rates very sharply during the crisis and kept them low until early 2022. And this is part of the explanation for the crisis that we are now in the midst of. But there's a famous book written in 1873 by Walter Bagehot. Walter Bagehot. It was the editor of The Economist magazine, which still exists today, by the way, and is something I read every week, cover to cover. I commend it to anybody who's trying to understand what's happening in the world. And Walter Bagehot back then said the response of a central bank to a financial crisis should be to lend freely against very sound collateral, but at a penalty rate. So to lend freely is what the central banks have been doing ever since. In every crisis, they pump a lot of cash into the economy to avoid the debt deflation spiral, and that's a good thing. The second part of the Bagehot rule was against good collateral, and that was true for the Fed in 2008. The Fed was very careful to lend only if the bank or General Motors or whoever was able to provide assets that would protect the taxpayers against losses. So the notion of why good collateral, and the answer is that if the central bank just lends to anybody and there are many losses, then the losses are ultimately paid by taxpayers, and taxpayers don't like that. So lend freely against good collateral. And the third thing Bagehot said was, but only lend at a penalty rate, because you want to avoid moral hazard. Moral hazard is the tendency of people to believe that once they've been bailed out, they'll always be bailed out. But if the central bank makes the borrowers pay at a much higher interest rate, first of all, they'll be reluctant to take such a loan. And second, they'll never forget it, that they had to pay a higher rate than every other borrower in the economy. But in 2008, the Fed did just the opposite. It was so worried about liquidity that it lowered interest rates because it wanted to reliquefy the economy. And as a result, it increased the money supply in the United States quite dramatically. The assets of the Fed from 2007 to 2010 rose by almost $4 trillion. Actually, it rose to $4 trillion by 2012 or 13. In any event, the Fed pumped a great deal of liquidity into the U.S. economy in an effort to prevent a depression and to provide the ready availability of money to allow the economy to recover from the crisis and go on and get back to growing. For reasons we still don't understand, the economy did not take off in the way that economists have thought it might. It grew rather slowly until 2017 and then began to grow more rapidly. And then the crisis of 2020 hit, the pandemic. That's a longer story. And the Fed added another $4 trillion in money supply. And only starting in 2022, at the threat of inflation, did the Fed decide to begin to claw back some of that liquidity in the economy. The liquidity helped the global economy. I want to emphasize that this was not simply a benefit to the United States. It provided massive debt facilities to central banks around the world because we're the leading reserve currency of the world. The Fed wanted to make sure that this crisis of hoarding did not affect Brazil or South Africa or Britain or Japan or even China. And so the strategy in 2008 and again more recently has been to provide liquidity without asking questions. But I think we see now the cost of doing that, which is inflation as well as the difficulty of reducing the money supply when good times return.
And in 2008 makes sense. The 4 trillion the years after, because it was a crisis caused not only but by the inexistence of liquidity of money in the market. So it makes sense to the government inject money. And after these 15 years, what have you learned from the 2008 crisis? And this year we saw the Silicon Valley Bank crisis. And can we expect? I know I know that math, economic, is it a precise science that say yes or no? But can we expect another crisis in the U.S. caused by the banks or at the banks?
The second question is easy to answer, and the answer is yes. There will be more crises because uh, the model of a bank is a fragile model. A bank borrows from depositors, and the depositors have the right to withdraw their deposits on very short notice. But what the banks do with the deposits is turn around and invest in long-term assets because they earn money on this what's called a maturity mismatch. They borrow short term and they invest long term, and they get to keep the difference between the yield on whatever they have to pay for the deposits and the return that they earn on the assets. So banks are ready made for crises. They, but we need banks to do that. And this is the difficulty of understanding crises and what to do about them. We need banks to mobilize capital, that is, to take it out from, as we say in the United States, out from under the mattress or from under the hearthstone in houses and put it to productive use in things that create jobs and make life better for the whole nation. If all the money did was to remain hoarded in every home, the economy would grow so much more slowly, and we would all really be in much worse shape. So we need banks to do what they do. The problem is how to engineer a banking industry in a way that reduces the probability of a crisis and yet produces the benefits of mobilizing capital. So the answer that has been learned slowly over time has been to impose regulations on banks, and the banks uh, the banks got rather sloppy in the 1990s and the 2000s, and some banks became extraordinarily aggressive in their desire to grow, and they neglected the adequacy of reserves against holding reserves against the possibility of deposit withdrawals, and they neglected the prudential risk standards for investing in loans and other assets in case of a recession. Well, when the crisis of 2008 came along, some of those banks uh, uh, began to collapse. They were taken over by other banks with the assistance of the federal government. The US government actually purchased the worst assets and allowed healthy banks to buy the remainder of the failing banks. That's also happened here in 2023. But the consequence was maybe we should ask banks to prove that they can withstand the shock of a crisis. So the Federal Reserve and the US Treasury Department began to impose the requirement for stress tests on banks. These tests are very elaborate computational exercises that force banks to prove that they will have adequate reserves and adequate capital in the event of another very severe crisis. And indeed, uh, the and the strongest standards have been applied against the largest banks, the banks that are deemed to be too big to fail and too interconnected to fail. We would never let those banks fail because of their deep interconnections throughout the financial system. Unfortunately, less attention was given to smaller and mid-sized banks, and what we saw in a month ago was the failure of Silicon Valley Bank and some others, and this has reminded us that uh, you know the standards of reserves and capital need to apply to those banks as well. What's more illuminating, however, in recent years has been that the fact that crises always break out in the shadows, as I said earlier, crises always break out in the periphery of the financial system, means that there are now debates occurring over whether to apply new regulations to institutions who are not quite banks, but perform many of the functions of banks. These would be money market mutual funds. These would be hedge funds. These would be mortgage loan originators. These might be venture capital companies. These might be pension funds, because all of these have had a role to play in the crisis of 2008 or the more recent crises. So, how wide do we extend the umbrella of regulatory supervision is a profoundly important question. It's the subject of great and actually very severe debate, because with increased regulation comes lower discretion, less ability to innovate, less tendency to move capital where we want it to go with the highest the most benefit to society and to the economy. So there's a fine line to walk. We want to regulate away the risk of severe crisis, but we don't want to regulate away the ability to send capital where it will do the most good for society, where it'll earn the highest returns, create the most jobs, and create the kind of prosperity we all want.
So we have learned a lot, but we still have to learn a lot more. As you said, in 2008, in the shadows of the banks, the crisis started. In 2022, 23, the same thing happened. But also, as I said, it's very hard to regulate those small, medium companies. But do you think the debates will lead to new regulations?
Um, Political situation in the United States leads me to believe there may be some new regulation in small and moderate ways, but I don't think a massive new regulatory regime will emerge from these debates. Uh, that is to say, unless the current crisis we are in becomes much worse. Uh, I it seems that as long as the Fed continues to raise interest rates, there will be a tendency for some instability among small and medium-sized banks. But many people believe that the extent of such instability will not be very large, and until the Fed stops raising rates, which might be in the summer or the fall of this year, we should let the markets um, be free to respond in ways they deem appropriate. Um, this book of mine, on the Panic of 1907, leads to one final thought in my mind, which is that it's easy for us to think of crises in very macroeconomic terms. And many of the issues you and I have been discussing this hour have been entirely appropriate and help us understand the why crises occur, why they spread, and how they can be quelled. But there's one added uh, influence that is often underreported, and that is the role of individual leaders to step in and act in very timely fashion. So, what crisis fighting ultimately requires are three things: speed, flexibility, and clout. Clout means power or size. Speed, we need speed of reaction in order to prevent the spread, the contagion of crisis from the periphery to the center, from the United States to Brazil, from one industry to the next. We need speed. We also need flexibility because every crisis is different in important ways from whatever the previous crisis has been. But so many times, regulators are like the generals who are always trained and ready to win a war that was just like the previous war. But crises are never like the previous crises. They're always different. So we need a response that's flexible, that differs, that's agile and able to respond to the unique features of the crisis at hand. And third, clout means power. It means having large financial resources, but financial resources deployed in thoughtful ways. So all of those three things can only be achieved with effective leadership. Leadership is, I think, important. And in all of my studies of the history of financial crises, I've identified the role of individual decision makers, policy makers, or even actors in the private sector who can intervene in very, very effective ways to prevent or contain the spread of crisis. In this book of mine on the Panic of 1907, J.P. Morgan, the founder of the big bank today, uh, stepped in to organize rescues for banks to prevent the spread of the crisis in 1907. Um, he was quite successful ultimately in what he did, but the crisis of 1907 turned out to be one of the worst crises in American history, and it's quite important as a focus for anyone who's interested in studying financial crises because it led to the founding of the central bank in the US, the Federal Reserve System. That whole story is an important story of leadership ultimately. And to anybody who's in college today or early in his or her career, studying the history of financial crises will be an extremely important foundation for your development as a leader in what might be a future crisis. I wish you very great success in your studies, in your professional work. Thank you, Enrique, for your good questions and your interest in the crisis of 2008. I wish you all success in the many years to come.
Thank you very much, Professor. It was an amazing conversation. I learned a lot from you. I have interest not only in the crisis, but in all the economy. I studied history, but I think when you study history, we can't be trapped only in the humanities. We have to go to the economy, to the science, and I tend to study more economy than my colleagues. But again, thank you very much for your time. Thank you for this amazing class, and I hope we can meet soon in a few months to talk a little bit about other crises. For example, the 1929 crisis. And is your book available on Amazon?
Yes, The Panic of 1907 by Robert Bruner and Sean Carr. It came out about a month ago. It's getting some nice attention, and thank you very much for your interest.
And thank you. So to all those who are listening, go to Amazon, check the book. I have already saw here. It's R$100. I think $25, something like that. And you have in Kindle and in the physical book. Well, check out the book of our guest. Thank you again for your time, your patience, and all your answers, Professor.
I shall resign the presidency effective at noon tomorrow.